FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's May 21st, 2020. Well, it appears we're in the midst of a major resource bull market. We always told you it was coming. You probably gave up hope. I mean, it was only been saying it since 2011. It was inevitable. But one person who has done more than probably just about anyone to ensure the survival of this sector, talking about precious metals, and to really give us hope for a better day, is none other than Sprott's Rick Rule. And Rick, it's great to have you back on. You know, you tell us you've experienced somewhere 3 to 4 major resource stock bull markets. And here, I don't think anybody can deny we're in the midst of one now.
Well, I think that's accurate. I think it's probably early to say that we're in a natural resource stock bull market, because my suspicion is that the industrial materials, the energy complex, will take much longer to recover. It's very clear to me that we are in a gold bull market, and we are entering a gold equities bull market. We can talk about that at length. In prior bull markets, or more correctly, prior recoveries from oversold bottoms, history teaches us that the market is led by gold. The gold buyer is a fear buyer, and the fear buyer always precedes the momentum or the greed buyer. So gold is always first, and gold needs to move before the gold stocks move. Gold stocks move as a consequence of the increased gold price showing up first on the income statement, then later on the balance sheets of the gold stocks. Silver moves after gold, and silver stocks move last. Patience is often rewarded because, in my experience as a class, the high-quality silver stocks, there are very few of them in the world, move the last, but they move the furthest and they move the fastest when they move. If past is prologue, which I suspect it will be, that same sequence will prove true this time as well.
Hey, and great point. And silver has just started to move. Now, I've had this theory, and I can't say it's based on science, but science and investing, well, we know how well that can work. But my theory, Rick, is that silver wouldn't make a major move, until gold hit 1750. And my feeling was that that's because it's kind of the midpoint between 1500 and gold's prior high. And at this point, people look around, they look at gold, and they said, gee, that's really expensive. And then they look at silver and they say, well, 15, 16 bucks an ounce, I can buy some of that. It's kind of like when steak gets too high in price, you buy chicken. Substitution effect. You think we're seeing that now?
I think we may be. And Kerry, I don't want to answer the first part of the question about what level the gold price would need to be for silver to follow, because that's really a question of market psychology, understanding popular culture. I don't own a TV, and as you can see, I don't know how to dress myself, so I'm not well equipped.
Well, it makes two of us
to address that. The circumstance that you describe, however, which is to say that silver has functioned for years as poor man's gold, is a very accurate observation, which is borne out by history. Borne out in the Western world because the silver speculator usually is younger, has a lower net worth, and the unit cost of silver appeals to him or her relative to gold. But more importantly, because the circumstance that propel precious metals higher often occur worldwide. And in places that have a cultural affinity to silver, I'm thinking particularly India, Pakistan, Bangladesh, and Sri Lanka, the lower unit cost is essential for people who want to shelter their savings in metal because they can't afford the unit cost of even small pieces of gold. So silver becomes the only available alternative for hoarding as opposed to the fiat currency in those countries. So the discussion that you've given with regards to how the market works is, I think, exactly correct, the substitution effect.
Yeah, and it's a fascinating thing. We see it it's not just exclusive to precious metals. We see it throughout our economic lives. Hey, price of Mercedes gets too high, so we look at, well, I don't want to give too many cars, but we look at a Volkswagen or a Ford or whatever. It's just human nature, and we've seen it so many times in precious metals throughout history.
In fact, Kerry, if you and I are still doing this 4 or 5 years from now, we'll see it in other commodities markets. If the price of copper were to get to $4.50 or $5 US, what you'll see is a substitution of aluminum for copper in wires, as an example. You will see fabrication technologies in electrical generation in cars that will conserve on copper. I'm not picking on copper particularly. I'm just saying that your discussion of the substitution effect in society is a very, very important topic for investors and speculators to familiarize themselves with in terms of natural resources, because markets work. Markets are messy and they take time, but markets always work.
Yeah, and you've always got these external factors trying to mess with the markets and make you think they're telling you something that they're not. And the way that markets communicate with you and you communicate with them is through price. Of course, sometimes the substitute effect can have dire consequences, as when in the, I guess it was the 80s, 90s, they substituted aluminum wires for copper wires in houses, but they didn't really know what they were doing. And a lot of houses burned down from that substitution effect. So you can't follow it blindly. It has to be a real substitute. And sometimes substitutes take place just with stocks, right? A stock will get too high, but there's a similar stock that hasn't moved that appears to have the same dynamics. So you jump into that and it may or may not work out. Yeah. So when we've been through this bear market, and I should have specified precious metals, miners, producers, explorers, discoverers, all that, developers. It was pretty dire for a good 5 or 6 years. Now, I know you've been in this business your entire life, but you had to have been pretty, I don't want to say depressed about it, but disenchanted, frustrated, because it seemed like the whole rest of the world was ignoring all of these fundamental issues that you and I deal with all the time, that we discuss, like escalating debt, like real wealth, real per capita income declining, all these things. I mean, what was the worst moment during this precious metals recession for you? What was the worst moment for you?
Losing money for clients. Easily the worst moment. The truth is, Kerry, as you know, I've been in these markets a very long time. And so I came into this bear market rich. And I came into this bear market extremely well cashed up. I also came into the bear market understanding that the cure for low prices is low prices. So for me, the bear market resembled a very long, very extensive, very cheap sale. And I would buy and stuff would go lower, and I would buy more and stuff would go lower, and I would buy a private placement and stuff would go lower. So I worked 10 years. I worked a decade to be what I am today, which is to say an overnight success. But the worst part of it clearly was trying to hold the hands of clients who hadn't been through these markets in the past, people who bought the gold narrative in 2009, 10, and 11, people who high-sided themselves. And people always come into a market on the high side. That's how people act. And losing money for very good people, trying to explain the circumstance to people, having them believe you once, seeing the stocks go lower, having them believe you twice, seeing the stocks go lower, and then seeing people capitulate in 2016 and 2017.
Yeah, right at the wrong time.
Extremely hard. Everybody prefers to be loved, and somebody like me is loved in bull markets. Bull markets are, of course, the most dangerous of all markets. People don't like to be hated, and you're hated in bear markets, and bear markets are perversely the safest of all markets. So the most difficult thing for me was losing money for people who I liked and trusted and who trusted me, and not being able, as a consequence of the duration of the bull market, to keep them from making the second mistake, which is, of course, selling at the bottom. That was very difficult for me.
Yeah, painful. What about the companies you work with? And you work only with good companies, Sprott. I mean, I think anyone who knows you, you do your best to weed them out and really find these. But these companies suffered. They were counting paper clips. I mean, they really, the industry.
Kerry, in fairness, the industry deserved to suffer because the excesses that they engaged in the decade 2000 to 2010, I must say that the worst pain that the mining industry suffered was self-inflicted. Idiotic investment decisions, squandering capital because the cost of capital was in effect sub-zero. The truth is that I wish in that regard that the bear market would have been more painful. When I look at the landscape of 1,500 to 2,000 so-called mining companies, listed mining companies worldwide, and I realize that perhaps 150, at most 200 are viable, I really wish that the bear market would have been more painful. If you look at the cost to society and the cost to investors of keeping 1,500 zombie listings alive, it probably costs $1 million a year to keep a listing alive in terms of salaries, exchange fees, all that kind of stuff. That means $1.5 billion a year goes to money heaven feeding zombies. It doesn't go into meaningful exploration. So I actually wish the companies would have suffered more.
Yeah, and I totally grasp your point there. The sector kind of reminded me of that movie Coma, where they send all these long-term coma patients, and now miraculously they're coming back to life to go suck more resources out of the market. And that's where I kind of perceive my role as helping you to kind of separate the wheat from the chaff, if you will, to really stay away from them. I mean, I have companies coming to me all the time of very specious, questionable value, and I'm just too busy for them working with real companies that really have viable projects and good profit potential ahead. So I totally grasp that, but unfortunately, again, it's human nature. Just like buying at the top and selling at the bottom is human nature. It's that it's been going on for hundreds of years now. The mining industry, precious metals, just kind of draw these charlatans to them.
Kerry, we rank listeners and viewers' portfolios, as you know, and I learned an awful lot about speculative nature by seeing the portfolios that are submitted to us for review and then talking to the owners of those portfolios. People will transfer in these laundry lists of stocks, 60 or 70 stocks that they own.
Yeah.
And so I'll be talking on the phone to some of these people, and I say, okay, let's go through the stocks. Let's start with the A's. Okay, Amalgamated Aardvark. I'm making up a name. It's got a lot of A's in it. And they'll say, oh, yeah, what do you think of Amalgamated Aardvark? And I start by saying, well, until right now, I was blissfully unaware of its existence. What do you think of it? And they say, oh, well, I hate the stock. And I said, well, if you hate it, why don't you sell it? In fact, why did you buy it? Well, I bought it because Bob Bishop recommended it. I said, well, Bob Bishop's been retired for 13 years. Why else do you own it? Well, I can't sell it. Why can't you sell it? Well, I bought it for $4 a share, and it's selling for 25 cents a share. And if I sell it, I'll lose $3.75. Then I need to say, no, you've lost $3.75. The question is, what are you going to do with the quarter? That is, in fact, human nature. We ask people, and I'm sure you would agree with this, Kerry, we ask people to limit the number of stocks in their portfolio to the number of hours per month that they're willing to work studying the stocks in their portfolio, not listening to video blogs, not listening to Bloomberg, but actually paying attention to the press releases issued by the companies, reading the proxies, reading the annual reports, reading the quarterly reports, understanding the filing statements, understanding the balance sheet, understanding the income statements. If customers did that, and I realize it's the impossible dream,
totally,
we wouldn't have 1,500 zombie companies, and people wouldn't be transferring in lists of 60 stocks to me where they didn't understand what the companies did for a living.
Is such a great point. And look, we're all in the story business, right? We're all in the story business. And then you go back to, well, how do you tell a good story from a bad story? How do you weed it out? And obviously prior success is certainly an indicator, but not a guarantee. The quality of the team. And then you look at the quality of the project, the ore grades, all these things. But even then, when you've gone through the list, you can still get burned. This is the most dangerous sector of the stock market by far that I've ever witnessed. As bad as things got in March, a lot of these big companies, maybe they lost 20, 30%. But if you were in them for a while, you made that last, so you lost a year's earnings, paper profits in a stock. This sector, like you said, can go from $4 to 25 cents before you even knew what hit you. And you need a certain risk tolerance. And how many of your clients really understand that? Maybe they do now after they've suffered all these years. But it took me a while to get my arms around the fact this is a very dangerous sector, but potentially enormously profitable.
Well, Kerry, you said a lot there, so let's try and unpack some of it. First, in speculation, which is different than investment, your expectation on each individual selection must be failure. Failure is much more common than success. And so to be a speculator, you must anticipate 20 or 30% losses on many positions, understanding that if you've done the work, that on some positions you will get 10 to 1 or 12 to 1 returns. So the returns that you get on your occasional successes must amortize your more numerous failures. And if you don't have the psychological predisposition to tolerate failure, you can't be a successful speculator. Speculation is really a consequence of anticipating the probabilities of a transformational event. It's about the process of answering unanswered questions, whether or not your speculation is in research or development, which is to say technology, or in exploration. Secondly, I think you err, perhaps, when you say that this is the most dangerous sector in the market. This is a dangerous market, to be sure, but I think this is much less dangerous, as an example, than technology stock investing, where access to knowledge about market cycles and access to information with regards to process is much more difficult to understand. Technology has performed for 25 years. And the nature of technology markets are different. Companies stay private longer, which is to say they fail more frequently in private hands. But I would suggest to you that technology is substantially more dangerous for the hardworking practitioner. There are very few of those, of course, than natural resources are. But I would also say that any natural resource investor or speculator that doesn't understand and doesn't continually repeat the maxim, bear markets are the authors of bull markets. Bull markets are the authors of bear markets. The cure for low prices is low prices. The cure for high prices is high prices. Yes. You must be a contrarian or you will be a victim. Mm-hmm. If you repeat those three maxims once a month when you look at your portfolio, you will do better than if you don't.
Okay, but here's the thing. Everybody who's speculating would like to think that you're entering into a trade with an edge of some sort. So when you're trading these stocks, how do you get the edge really? Is it talking to management's work? Work. That's how.
How many of your listeners, how many of my subscribers spend 1 hour per month specifically studying each stock in their portfolio? The answer is probably less than 5%. And I would suspect that the performance correlates very, very, very closely with the work that went in. The edge is really easy to get. It's a function of work and being semi-rational. I'm not trying to say be rational, because being completely rational is probably asking too much. But asking somebody to read the proxy, asking somebody to understand if there's a change of control premium to management, which would cause the management to be incented to see the stock go down so they can sell the company and get a premium. Little things like that, and they're actually little things, are the key to success. Most people's technique is pay attention to price because that information is easy to obtain, and follow the maxim, got a hunch, bet a bunch.
Yeah, that is dangerous. So maybe I go back and I say, maybe it's not the sector that's dangerous. And I totally agree with you about tech stocks that we watched the .bomb era. But maybe the most dangerous part of the whole process is attitude and looking for the easy score. So when you're scouring the public info on the stock, there's usually something in there that is more important than the rest of it. And it varies from company to company. But what's the aha? Where are the places you need to look first?
FSN Radio. It's all about what's next.
Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com.
The Financial Survival Network. It's all about what's next.
My first screening technique is to look for management teams who have been successful in the past. That is, before I start looking too much, I look for a management team that's been successful in the past. Now, I have the luxury at Sprott to have 8 geologists working full-time looking at the news to draw my attention to companies that I ought to look at as a consequence of drill holes, an advantage that other people might not have. But I try and I try and look for correlation between good drill holes and good people. My initial screening technique is always the same. I call the management team. I congratulate them on their success. I compare notes with who they know and who I know. I try and become a bit familiar with them. And I say, listen, I'm really interested in owning your stock. What I want you to tell me is what is the primary unanswered question surrounding your assets that you can answer to materially increase knowledge and hence materially increase the value of your company. How long will it take you to answer this question? What data caused you to develop the thesis that you've advanced to me, and how are you proposing to test it? In approximately 80% of the cases where I ask that question, the management team answers back, well, I've never thought of it that way. Now, what that means is that to them, their unanswered question is, will I still be drawing a salary in 18 months? Which, while I understand the validity of that question to them, it has no importance to me. So I am able, as a consequence of asking that one question, to throw away 80% of the names that have been presented to me. And throwing away names, not wasting time on companies that are likely, not certainly, but likely to become valueless, is very, very important as a screening criterion to me. The second thing is that you have to go through the validity of the suppositions that have been suggested to you. Let's say that the aforementioned amalgamated aardvark let's say they have a deposit and they have a surface anomaly and all these good things. And let's say that the unanswered question involves the third dimension, which is to say, does it extend to depth? And what is the width and what is the strike? And to test that, they propose a $5 million drilling program over 18 months. And let's suppose, too, that it costs the company $2 million a year to stay alive, salaries, filing fees, office rents, and stuff like that. That means over 18 months that they have a need of $5 million for exploration and $3 million for G&A. In other words, it takes them $8 million to answer the unanswered question. Well, let's say then that they've given me these numbers and I look and they have $600,000 in the treasury. What that means is that without substantial dilution, which may or may not be available to them at all, they can't answer the unanswered question, which is to say that they are valueless. They have no value. They're zombies. If I believe that they'll be able to raise the money, particularly if I believe that I would be willing to put it up, then I have answered an unanswered question. But I certainly look at the fully diluted valuation of the company rather than the pre-money valuation of the company when I am valuing the outcome, the probabilistic outcome to answering the unanswered question.
All right. So it kind of goes back to known knowns and unknown unknowns.
Correct.
And known unknowns. And so I think you've given us some good insight into this and the mindset, because every entity in this world known to humanity, whether it be single cell organisms or huge governments, their first order of business is survival, right?
Correct.
And so you've got to deal with these guys, and you have this with lifestyle companies. I like the concept of a lifestyle company for me, but not having to answer to shareholders. That seems to be, to me, the lifestyle company in a mining industry seems to be inherently untrustworthy and just loaded with conflicts here. And nobody is looking out for the hapless investor other than us trying to educate that person, right?
Certainly important that the investor understand that. My mentor in investing was a deep value investor named Peter Kundal, rest in peace, wonderful man. And I remember Peter telling me when I was a very young speculator, I would say I was 23 or 24 years of age. And Peter and I were talking about risk. And Peter said, Rick, always remember, the greatest investment risk is easy to locate. It's to the left of your right ear and to the right of your left ear. And if you can go some distance to minimizing that risk, the other risks become de minimis.
Yeah. So it's all upstairs. It's all in your mind. And that's where you need to keep it, because you need to take responsibility for the outcome. Not so-and-so told me to buy this and I got a tip and all this. We all know how those things usually work out here, and not well. So we kind of addressed gold and silver, that we're in a resource, particularly precious metals, a bull market. I guess and we've talked about what makes winners. What's ahead of us here? What is your take? How long is the gravy train going to go on for?
Kerry, you know I refer very frequently to the Barron's Gold Mining Index chart. I refer to it because it's the broadest and most inclusive index I know, and also because it goes back the longest. It goes back 50 years. Looking at that chart tells us an awful lot about the bull market that I believe that we're in. The first thing you see looking at that chart is that the bear market that we have just been through, the 2011 to 2019 bear market, was both extraordinarily long and extraordinarily vicious. If you follow the bear markets of the authors of bull markets and you look at that chart, you will see that if we aren't on an upcycle, we are certainly past the bottom of the down cycle, and a historic one. The second thing we learn is that there have been 8 prior recoveries from oversold bottoms. I'm not talking about bull markets, but merely recoveries from oversold bottoms. In those recoveries, the index itself, not the best stocks in the index, but the index itself, has registered gains, trough to peak, of 180% on the low side and 1,200% on the high side, which tells us that if we are beginning at the early stages of a recovery, never mind a bull market, that the upside is substantial. The third thing that you see from the chart is that these recoveries are steep, but of 2 to 3 at max 4 years duration. prior recoveries have been over periods of time as short as 11 months and as long as 42 months. And it's important to note when looking at the chart that the backside of those recoveries is just as steep as the front side, but substantially less fun.
Yes.
Which means that you must remember to take profits on the way. Bernard Baruch once talked about market timing by saying that the only guy who ever bought at the bottom and sold at the top was a liar. It didn't happen. And so you need to scale into bear markets and you need to scale out of bull markets, which is precisely the opposite of your instinct. But the chart teaches us this so clearly. I'm not a technical analyst, but I love a visual aid which puts history into context for me.
Yeah, and we will post that. We'll try to put it on the video. We'll post it on the site in the show notes, the Barron's Gold Miner Index. And your citing of Bernard Baruch reminds me of one thing that I learned the hard way, but then it was so obvious. Bernard Baruch, someone was once asking, well, how did you make it big? How did you do this? And he said, I got rich letting the other guy make the last 10%. and that should just be an admonition that greed might be good, but it can be fatal. And you have to rein it in. And you really got to think in terms of, like you said, that the reversion to mean is a very powerful force of financial markets. And we've all been tripped up in it. And, you know, it was just like, Rick, we talked about Bitcoin when it hit its peak. It seems like it was years ago now, 2017, December, I think, or 18. And it hit 19,500. But you looked at that chart, and as people who've been burned so many times by it, you looked at the chart and you knew what was going to happen, right? You just knew it. It couldn't go on that way, right?
I think you knew it, Kerry. I don't look at charts that reflect industries that I don't understand. And I do it deliberately because charts measure price.
Yeah.
And I think that price is only valuable if you have an opinion about value. I recall you and I talking about Bitcoin at the time, and I didn't really have many comments because I didn't know how to value an intangible. Bitcoin was valued for its utility, which was alleged to be frictionless transaction, and its anonymity. The problem was, as a medium of exchange, it was so volatile that people weren't using it in a way that demonstrated any volatility. You couldn't buy a cup of coffee with it because you didn't know in the context of its volatility whether you were paying 75 cents or $5 for that cup of coffee. And the merchant couldn't accept it as well. So I didn't understand the value proposition, the utility of Bitcoin. And as a consequence of that, while the chart might have been useful to somebody who understood technical analysis or somebody who understood market psychology, I deliberately didn't look at the chart because I didn't want the chart to tease me about information that I had no ability to understand.
Yeah, I firmly embrace what you're saying, and I'm not by any means an expert in Bitcoin or cryptocurrencies. I kind of get it, and I like the theory of it. But when you see any market advance as quickly as that, with multiple busts and then complete recoveries, retracements, you just know that this is not a market for people with high blood pressure or who are on the edge of reality challenged people, put it that way. This could break you. And honestly, so can precious metals markets. I just remember 2011, and I was on a high for a few years. I started buying like crazy in 08 and 09 and never thinking that it was ever going to go down again, because I really thought that this time was really different than all the others. Currency collapse, whatever it was going to be. And then I learned that, no, you can't, it might be going where it's going, but you know, the idea of how it's going to get there, it's going to get there the same old way that it always does.
Kerry, I actually got it wrong twice. In the immediate aftermath of 2008, I understood that the policy response would be very good for precious metals. But I thought that the policy response would fail with regards to the broad economy. So I did quite a good job of buying at the end of 2008. And then I sold fairly aggressively in 2010 during the recovery, meaning at least in terms of precious metals, I missed the last half of that recovery. Yeah. I began to buy back in reasonably aggressively in 2013, 2014, precisely two and a half years early with regards to the 2015 bottom. So I'm delighted to say that rather than being wrong once, which is not uncommon, I was wrong twice. Yeah. Mercifully, I had enough retained earnings and I had enough staying power and enough other things were working in my life that those errors, while unpleasant, were certainly less than fatal.
Yeah, and now we find ourselves here in a new world. Yep. And, well, we'll see about the fiscal policy this time, what its results are going to be. Nobody knows for sure, but, it's we're in uncharted territory, at least in terms of modern times. Probably they were thinking the same thing in Rome, in Greece, in the Byzantine Empire, in every empire, in those end days. How much longer can you go on? But all we need to do is follow a discipline, and we'll protect ourselves. And Rick, you write Sprott thoughts. Where do we find all this great info and stay up to date with what you're doing and your thoughts?
Well, thank you for the opportunity. I would like to make more than merely our thoughts available. I would like to offer to your listeners and subscribers the opportunity to have myself and the Sprott team evaluate your precious metals portfolios. All you have to do is go to a web link. That web link is sprottusa.com, SPROTTUSA, all one word, .com /rankings. You will have the ability there to input your natural resource portfolios, and we will rank that portfolio on a 1 to 10 basis, 1 being best, 10 being worst, and comment on those individual issues where we feel that our comments might be of value. In addition, we will email back our rankings to you with the Barron's Gold Mining Index 50-year chart and a 100-year commodity chart, not as a tool for technical analysis, but rather as an illustration for where we are in terms of the gold mining equities specifically, but also the commodities generally. In the case of commodities, in a relative valuation basis, over 100 years. Certainly, if you want to hear the rest of what Sprott has to say, the Sprott US Media website, subscribing to Sprott's Thoughts, is a great source of information, and our YouTube channel, the Sprott USA YouTube channel, which has about 200 hours of educational programming on it for free, are useful sources of information.
All right, we appreciate that, and there will be a link in the show notes so you can go to those venues and get educated, because that's what we're all about. Rick, really appreciate you coming on, and we'll follow up with you in a few months and see where this thing goes.
Always a pleasure. I've enjoyed the conversations, as I always do, Kerry. Thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.